Hi, Liana. Thanks for joining us again.
Hi, Mike. Thank you for having me. So, I want to talk about the portfolio. How have things been for the first part of 2025 so far?
Look, it's been interesting. I mean, there's been some huge upwards moves in some growth stocks, but I'd say it's been pretty choppy for the markets overall. Uh, on Friday, there was a bit of a sell off. It seems like there's been a couple of Fridays like that. Um, the CEO of Microsoft had a really interesting podcast with Dwarkesh, which is well worth listening. But there was one moment in particular where he zoomed in on talking about overbuilding in the industry, and also talking about how he is very happy to lease because he thinks prices are going down. And I thought that was pretty interesting because he's one of the few people that determines global capex on data centers. You know, and if he thinks there's overbuilding, that probably doesn't suggest that he's full steam ahead at the moment. And there's kind of parallels like what we've noticed. We've seen all these neoclouds set up. They're really just excess providers of supply of what's very commoditized. Funny because it's a commodity that's produced by one company. So that was one of those moments where you think, okay, it does seem to be a few signs now that the cycle on that capex is turning. And even if the capex numbers stay really large, you're not going to see that 100% plus growth that we've seen the last couple of years in some parts of that sector. So that seemed to kind of rattle things. We also had three companies with big reports come out. So it was Nubank in South America, MercadoLibre, and there was some news on HIMS as well.
Right, and HIMS has been in the news a lot recently. They had a Super Bowl ad and they also announced at home testing. So you can take a
Yeah,
blood
for
test at home and send it in.
Yeah, well, the key thing about them is a huge part of their business is GLP-1s. And there's kind of a loophole where they were able to use compounding versions, cheaper versions of the drug, that basically not buying them from the owners of the patent. It's pretty unusual when you think about it. It's not often that you see people sell generic versions of drugs before they're off patent. Like, that's the whole point of patents. But this was like an unusual case. There's like a situation where if something's technically in shortage and declared in shortage by the FDA specifically, that people are allowed to compound their own versions. And on Friday, semaglutide, like the Zempic, the original, the OG, that was taken off that list and the shares dropped 25%. But for a bit of context, it's still up over 100% this year. And funnily enough, the company's reporting tonight, so we'll get a lot more information on it. So whatever we say now might be quickly dated. But this is like one of our classic explosive growth customer love stories. It's the whole point of that framework is it lets you identify the best top performing company in a sector, and telehealth, which is kind of like DTC health, that's been like a thematic that has been around for years. And in the kind of boom of 2020, 21, and the 5 or so years leading up to it, there was a company, Teladoc, which was on everybody's watch list and everybody was talking about, and has been an absolute wipeout. And there's like a number of competitors in the space, but it does seem like consumers are voting with their feet and going for HIMS. It makes you wonder why. And I think it's amazing. Silicon Valley, they're now calling it TASTE, what like a well-designed product, well architected, good UX, good customer experience, how far that can take you. You could see it in the numbers. The growth has been immense across multiple different products. It's the other interesting thing about it is that the short interest is like over 30%. So this is a very heavily shorted stock, which is probably why it went up, 150% plus in a couple of months. So now it'll be interesting to see what happens, because the short case was basically that semaglutide would be taken off, Ozempic would be taken off that shortage list, and they would be able to compound it. But that's not the end of the story for HIMS. Like, it's only one of their products, and something similar happened in Australia where they said you can no longer use compounded versions of these drugs, and then Eucalyptus and Mosh just immediately switched to branded versions and lifted the prices, but by all accounts, are still doing extremely well. So it is
Right.
one of the most interesting companies, I think.
And we've identified HIMS as one of those true customer love companies. Do you think that that's enough to also bring them through this? It's something that would keep customers loyal, even though they could get the same product elsewhere. And I also want to
Yeah,
come back to this, but do you think sets a company apart or a product for being true customer love? Is it the experience, what they're offering? Because these certain brands, they're really set apart from the pack.
yeah. It's starting a couple of questions there. So, like, what makes it? That's the hardest bit. I mean, like, why are iPhones so much better than Android phones? When the iPhone came out, Nokia was on top, and they had huge consumer success. Everyone was using BlackBerries as well in the business world. There was no guarantee that Apple was going to do it. And of course, these products are in the public sphere. So any features that they put in could immediately be copied and were. And in many ways, actually, the Android phones had better features. It's some mix of like product quality, design, X factor, UX. It's hard to describe. And then once that started building, and then in the iPhone in particular, once it becomes embedded as like the luxury product, then all of a sudden, consumers voted with their feet. Something like HIMS it's harder to pin down. But there's some websites that are just an absolute delight to use, and some that are agony. And the original telehealth versions were just like buggy and slow, and you couldn't find anybody. And they've just made it really easy. And that's why that explosive growth piece is so important, because that's like by far the most important thing over what. That's far more important than like your opinion. So let's say we like reviewed 6 different telehealth or direct-to-consumer offerings in the United States, we might actually come to the conclusion that actually this one is better for a number of reasons. And you could do the same with smartphones. There were times when HTC, everyone was saying like this phone is the best one, and they might have been true, but it wasn't relevant. The good news is we don't need to guess. We can see it. We can see that not only is HIMS growing extremely fast across product categories and rolling out new ones, but also that more and more customers are using their personalized services, which obviously involves greater contact, better customer retention, more value capture, more loyalty in particular. I think in terms of like what makes those companies so good, the most important thing is to like notice that everybody's consumers are thinking it's good, which again is like a different approach, because usually when people approach investment analysis, they'll kind of form their own opinions, whereas often it pays to catch what consumers are doing, instead of reading a 100-page report on features and the analysis that you've done. That doesn't matter. If everyone's queuing up for iPhones it is, and that's just going to build on itself. That's why there's both of those things. It's not just true customer love, because there's plenty of brands that could tick that. And once you tried to pin it down, it'd be almost impossible to pin down. It'd be very hard to describe. You might be able to like I know I always buy iPhones. It's very obvious to me why I buy one, but it's not what's relevant to the investment case. It's what's everybody else buying. It's not about guessing where the herd's going to stampede next, but they are eventually going to follow the customers. And I think the main insight of that whole strategy and that whole philosophy is starting with the customer and focusing there. And you'd be surprised how rare that can be sometimes in the investment world.
So what do you think happens next with HIMS?
Look, a lot's going to depend on the report tonight. You got heavy short interest, but the move that they expected has happened. It's rallied so hard, the next move is likely down. Everybody's rushed in, it could unwind. But really, these things tend to top out when that short interest finally closes. This isn't like a fraudulent company. As far as you can tell, something isn't. It's not like they're not growing their subscriber base. They don't have multiple products. And also, if they have to sell the branded version, that's not the end of the world either. The prices for the branded versions have come down. Ozempic is not in a shortage anymore. It's also not in a monopoly position. So at the start, it was the first product that had like global mindshare that people were actually aware of in the GLP-1 space. And if HIMS has a customer relationship, there's no reason for people not to continue to use them. So I think what happens is extremely volatile stock now. But I think they just keep grinding up their customer base, keep adding products, solve the GLP-1 issue. It quite likely continues to be a top performer. But of course, we'll be managing this with risk models, and we've already sold a lot once it went up 150%. Positions like significantly smaller than it was. But you just know this is going to be one of those stocks that's fought over by the longs and the shorts. It's going to have periods where it collapses, and then it's going to have periods where it doubles, triples, quadruples. We just had one of those periods. Now it probably needs to take a breather. And then they'll report tonight. In 3 months, they'll report again. In 3 months after that, report again. They'll be bigger each time. So that's kind of what I think will happen next. But it's definitely one to watch, because particularly if you don't have a position, it's an exciting one. Obviously, every share is held by somebody, but in this case, there's a huge amount bet on it going down as well. So it'll be interesting.
Absolutely. And a lot of HIMS value, from what I've seen, isn't just the products that they have to offer. Like, weight loss GLP-1s online. It's not all just people logging on and ordering something for pickup so they don't have to go to a doctor or pharmacist. A lot of people are on there for the actual long-term plans, and I think a decent amount of their revenue split comes from reoccurring customers who have something made up for them and their monthly subscribers. So HIMS has so much more to offer than just their products at face value, which could contribute to the overall true
Yeah, exactly. That's that personalized medicine piece. Once people are on those plans, they're not just gonna leave, and they've made a huge strategic push into doing that, which does differentiate themselves, and it does massively increase the lifetime value of their customers. Obviously, the whole process around getting access to prescription drugs is a complete nightmare. It's like in Australia, there's pharmaceutical lobbies. So chemists make old people go in far more frequently than they need to just to pick up their prescriptions, just to make sure they keep having the business. Obviously, you have to see a GP sometimes just to get a script, when really, what is that really achieving for anything? It's particularly if it's just something simple like, do you have any allergies? Have you tried this before? Did it work? There's 5 to 10 questions that they're going to ask. I mean, maybe those should just be asked digitally, and you just should give your answers. Obviously, if you want to lie to a GP, you can lie on the internet as well. It's not like they're going to catch you out. So yeah, there's definitely a space where there could be huge improvements in efficiencies, in cost savings, and definitely in customer experience.
Do you think that AI will ever have any role to play in telehealth, or do you think that's going to ruin the value that's given to consumers if they log on and they're just talking to a computer about personal medical issues? Do you think there is a space where they could make it work?
I mean, it's likely that, it's a space that a ton of different startups are working on. There's 2 parts. Will the doctors ever hand over control? Because they have a lot of control. They're on the boards that decide these things, like what's prescription only, what medicines do you need to see a doctor for. And then there's what will customers want. Do customers want to go see a GP, a doctor? I'm probably on the side that computers do this stuff better. If you see a GP, how much are they really analysing things? Do they really know the latest results? AI is far more likely to pick up on certain things. Even like the base models, even like XAI or OpenAI, you can drop in like X-rays, you can drop in scans, you can get really good analysis, second opinions, third opinions. You can ask all the different AIs to help you diagnose and ask the right questions at the very least. I'd prefer that. I mean, computers don't get tired, they don't make mistakes, they don't miss things. They're up to date. It is the future. I mean, we don't really have any direct investments in that. As far as I'm aware, all those companies are private, and it's a very well-funded space in VC land. So it's probably a space that's a ton of money is going to be lost, because there'll only be, all markets usually end up with one major player, one minor player, and a bunch of tiny players. And so if 20 different startups have been very well-funded at very rich capitalizations to pursue an opportunity, there's a good chance that the vast bulk go to zero and a lot of money is lost. Which is why public markets can be really powerful. And coming back to that true customer love and explosive growth, usually one company does win. It will be the one that the customers use. Like, that's why that strategy works. It will be the ones that the customers follow. I remember speaking to fund managers at the time. It was like the value pick for a long time, and it just continued to go down. Ultimately, it was down a huge amount. Then it became obvious that Apple was going to win not just luxury customers in San Francisco, but also the business world. In private market, I think the VCs, it's a tough game for them, because they obviously need to back the ones. They can't invest in every company they want to. They might only get access to the 2nd, 3rd, or 4th tier. All the companies that exist now, there might not be a single winner, and it all goes to someone else. There's heaps of examples of that. For example, in search, there were a bunch of engines. Every single search company has gone to zero, basically, except for Google, which captured the whole market. And Google was not the first search engine. There were a bunch of search engines in the 90s, none of which really exist. Maybe Yahoo exists. But yeah, I think it's tough. I think VC investing in AI right now I don't envy. They're probably all riding very high. Everyone's marking up their books, like everyone's capturing all this value, but they only really exit at the end, right, of the journey. And it's just so unclear. To be an entrepreneur in the AI space, super exciting, because everyone's willing to fund these things. And you don't need large teams at the moment to launch businesses. In fact, the new trend is extremely small teams. And because it's like greenfield opportunity, you can very quickly gain customers and revenues. In 5-10 years, all that stuff's going to be locked down. If you want to advertise for some AI doctor, you're going to have to compete on Google, on Meta. The companies that have succeeded and have huge revenues, they're going to pump up the price of all that advertising. So kind of in this like land grab period, which is super exciting if you're a founder, I guess if you're in VC, or even if you're just watching. but there will be money lost because, for all the companies being funded, there'll basically be 1, 2, maybe 3 successes in each sector. So yeah, it's tough. At least with us, we'll have risk models, we can swap, we can change. That's how we're going to try and stay on top of it in our field.
Speaking of ads, I sometimes feel like I'm living in that South Park episode where everything is an ad. And all the people
I need to see that. I need to see that episode. Love a bit of South Park.
Oh. Clarity came out with an update that their treatment for prostate cancer has been fast-tracked by the FDA. What do you think of that?
Look, I think there's a fairly muted market response. I think it was something people were expecting. Clarity's pretty topical now. I mean, I feel like it was one of those companies that went from nobody knowing to everybody knowing. A lot of people owned it. A lot of people had large positions. It peaked at $8, $9. It then sold off. There were these rumors of somebody being margined up and having to sell, margining up at the top, like borrowing money and having to sell on the way down. I think that was a bit of a smokescreen, though. I think that it was more one of those times where a company goes up 8 times and then drops 50, 60%. There was also a bit of a wave of M&A, and then there was the question of whether, like, part of the investment case a year ago was that Clarity might receive an offer, but that didn't happen. And then a couple of those acquisitions didn't go well. Point Biopharma didn't go well. One of the alpha particles, the trials had to be halted, and the heat's kind of come out of the space. There's also a company in the US, Janux, and another one, VIR, which both came out with pretty good data, different approach, but the same kind of 50% plus of their patients dropped 50% or more in PSMA, which is roughly in line with the data that Clarity just announced, where I think it was 58% of patients across the last couple of cohorts had drops of PSA of 50% or more. It's unclear how durable the responses are, and also it's a different mechanism. So as you'll know, with oncology, there's multiple lines of treatment, so it's not like one or the other. There's a good chance if they both work that they both form part of a treatment pipeline, and where they sit, who sits in front of who will come through on the data. And the other issue with Clarity is that revenues are pretty far away. There's a lot of catalysts, but actually product to market, you're talking 2+ years for significant revenues, and probably at least another decent raise between now and then. So the combination of all those things, there's a lot of shorting into it, and some days, it's over 20% of the volume is short selling, and that's tracked. Everyone has to report it, so you can see that on a daily basis. So I think what's happening is people are shorting it ahead of the cap raise, and then they'll get filled on the cap raise. Or if they don't get filled, the share price will go down anyway, and they can buy below the fill price, which is actually a really good business. I mean, that's pretty good. That's been a pretty successful strategy for funds like Regal. Revenues are pretty far away. Data is good, but we need more data. We need more cohorts. We need to see what the full phase 2 for the treatment, what that looks like across all numbers. Is it 58% plus? Is it lower? Is it higher? How does that compare to these other phase 1 or early stage trials? Those are all open questions. The good news is we'll get more data in March and then in September on treatments. So they're potential pivot points where the kind of market sentiment could turn. And then their diagnostic asset is probably a bit of a sleeper asset because Telix has done exceptionally well. The market for that is far bigger than anybody predicted. But in the meantime, it's just a momentum unwind. Everybody bought it, everybody owned it. Anybody who was going to buy it bought it, and the stock's kind of falling. I think the issue they have is they're undercapitalized relative to competitors. So I feel like it's a common theme in Aussie biotechs where the CEOs always think that their stock is undervalued and that they'd be valued higher in the United States. Sometimes that's true, sometimes that's not. To give an example, Janux IPO'd $350 million US, so 500 mil Aussie, more, 550 mil Aussie. Clarity's proud of the 110 mil, but they've got like 20% of the cash at Janux targeting the same opportunity. So on the one hand, Aussie CEOs are sometimes right, where companies here can be undervalued. On the flip side, they're never capitalized anywhere near as well as the United States counterparts are. And I think part of that is a reluctance from management teams, for better or worse, not to dilute. And then I guess it's human nature, like fund managers, private investors, retail investors, we're all kind of the same. Like stocks go up and you think, wow, this is going to the moon. Like, I don't want to raise money now. I'm not diluting. This is the best thing ever. And then all of a sudden it goes down. But I think the dynamic for Clarity is an unwind of a lot of kind of tourists in pharmaceuticals that aren't specialists. A lot of people bought stock below $1, $2. The stock's still above their last raise. So a lot of people sit on big profits and might just lock them in. And then you've got the short sellers coming in, and then you've got the M&A boom seems to have cooled down, but 2 new T-cell approaches to treating prostate cancer early stage, which are also taking the heat out of the market because you can't have as much conviction because you don't know how good these new competitors will be. There's like a long list of things that have kind of cast a bit of a pall over the stock. And it will probably take something to turn around. It'll probably take good data in March and then throughout later the year. And then if it does turn around, the shorts have to rebuy, everybody who's sold takes another look at it. It'll just be one of those classic market stories.
Do you think that good results from this FDA trial would gather the excitement needed around it to have it go back up again? Or do you think it would take more than just one round of good results, like we would see maybe in March?
It's a good question. I think if it's in line, I think it would need to be better than expected to turn it around in the near term. But I think this is also a time thing. I think they just need to get through these trials. I think they need to progress. I think those first revenues need to be closer. They're kind of like a bit out of sight at the moment. In 6 to 12 months, they'll be different. They'll be within sight. Once this phase 2 is done, or this dose escalation trial is done, they'll then finalize a phase 3 trial design with the FDA. That's often a really good point to raise money. It's often a value inflection point. It's a good point to do deals, not necessarily sell the whole company, to partner. There's a lot of opportunities. Like in 12 months' time, the position could be much more positive and the share price could be much higher. On a 3 to 5 year view, if they do win in diagnostics, and they're going head to head in diagnostics, so it should be relatively convincing data that theirs is better. If they demonstrate head to head that it's better, then people start to consider, well, there's like 20 billion market cap plus right now in diagnostics. Some of that market is going to go to Clarity in the future, and that could also re-rate the stock. So it'll take a bit, but it's one of those things where you almost just need 6 to 12 months of time and readouts and progress. That's probably going to be the deciding factor.
In the beginning, you mentioned that Nubank and MercadoLibre had just reported. Was there anything out of the ordinary in those results?
They had very different market reactions. So Nubank dropped 19%, I think, and MercadoLibre rallied, over 10%. Studying MercadoLibre, I mean, that's clearly, it's just going to be a long-term winner. Like, it's just growing consistently. It's still adding. It's kind of like going to be the Amazon of South America. No one's going to be able to compete with them or build the infrastructure that they built. It never went crazy high valuations, or certainly isn't now. So I think that just continues to grind up in line with their revenues. US dollar revenue growth, 38%, gross profits up 26%. I think they're very reasonable base cases in terms of return over the next few years. We've obviously owned it for a very long time. It's about a 5% position. Nubank was more interesting. I mean, we bought that kind of in high fours, and then it ripped up to 15, 16, and we kind of took our 3x and then kept some. They had it's one of those tough ones. It's like one of those ones where it misses, and there's questions around profitability and like all these short-term things. But if you step back just even like slightly, it was wild. I mean, deposits grew 55% year on year, revenues grew 42% year on year, profit grew 47%. They've got 114 million customers. This is a company that like barely existed a few years ago. 140 million is a lot of people. It's the app that everybody uses. If you speak to somebody from South America, they'll happily pull out their Nubank app and tell you how much they love it. And customers have continued to grow. There's 4 million extra customers this quarter, so which is a bit under 4%. That's pretty good quarterly growth because they're growing revenues and revenue per customer faster than they're growing customers. But we've got to manage risk here. So for us, there's a good chance we'll reduce that position down. And it's not like it's without risk either. I mean, there were other fintechs that looked like they were going to do what Nubank has done. There were total market catastrophes. They're companies like PagSeguro or StoneCo. They really had the opportunity. They had the funding. They had everything in place to kind of take the market that Nubank has gone for, but they didn't. And there's no guarantee that doesn't happen to Nubank either. So I think with these growth stocks, you just have to manage them. You have to manage the risk really carefully and be really bullish when the results are good, the explosive growth is there, the customer love is there. But the unwinds are ruthless and can be 60, 70, 80%. And then these stocks can unwind for whatever reason.
Why do you think it would have had a reaction like that if on paper they were doing so well, if revenue grew, if subscribers grew by 4.5 million?
Ultimately, there are a couple of things. I mean, the currency depreciation didn't help, but really net income kind of contracted. So the return on equity dropped. Basically, profits disappointed. So top line increased by 58% over the year, but net profits, a fraction of that, 31. But also gross profits kind of flatlined the last 2 quarters, where people are seeing growth, the profitability is kind of not tracked the revenue growth, which was below expectations and caused a sell-off. For them, it's our return on equity, it's it's customer growth, it's average revenue per customer, it's gross profit per customer. Will they be able to move all these new customers down that revenue growth pipeline and generate more value from each of those customers? That's what's going to matter most in the long run. But obviously, when you're around earnings, it's like expectations. It's like, did the stock go up 20 or 30% before the earnings, and now it's just gone back to where it was? This stock did have one of those big rallies in the last 4 weeks. I think there's a lot of noise in it as well.
Why don't we return to the true customer love and explosive growth? Because we touched on true customer love, but I'd like to hear more. Is there anywhere that you're seeing explosive growth, especially in the market right now?
I think there's two parts. I think there's a lot of individual opportunities. We touched on HIMS. That's a very fast-growing company. There's one in insurance that we're invested in. There's actually one in real estate, a real estate agency that's got quite a different model to all their competitors and is growing exceptionally fast. We think these are kind of earlier stage as well. So the insurance one is Root. They basically use driver data on your mobile phone to help price insurance. It's not just your speed. It's like your jerkiness. Are you driving at 3 a.m? All those kinds of things give out a lot of information that's generally not taken into account, but also their customer acquisition funnels as well. So that part of the business is extremely important because there's a huge amount of value in capturing customers. The other part that's kind of been interesting over the last 2 years, and it's interesting now because it might be inflecting. So one of our original ideas was around Tesla, right? Like that, they're hundreds of billions of dollars of equity value, almost all in the public markets. It all happened relatively fast. And it happened over a period where automakers did pretty poorly. But there was a moment where that explosive growth stopped, and the share price hasn't really moved very much since then in the last few years. And I think that noticing that inflection, noticing when the grading times stopped, you used to have to wait 6 months to get a car, and then all of a sudden now they're discounting. Those are the kinds of shifts that you really need to look for, and they're the kinds of signs of customer demand and that enthusiasm and excitement and customer love that made it a multi-$100 billion company softening, and then the stock market performance deteriorated after that as well. Now, where could we be that now? It's possibly in semis. So if you think about what we talked about those industries, it's a framework for finding the best company in terms of value creation in a highly competitive sector. That's why it's helpful. The HIMS was an example in direct-to-consumer healthcare, and that next wave of personalized medicine and telehealth, direct-to-consumer, having to classify it. In semiconductors, there was a similar one where there was one company which everybody loved, which was NVIDIA. Every developer who worked in the space used CUDA software. They also did some very smart acquisitions, and they can link up their chips in incredible ways. So you don't just buy one NVIDIA 100, it can link, and you can link a number of them together all the way up to data center scale, and then run these huge large language models. They're really only the solution in town, other than perhaps Google's own chips, which they don't share with anybody else or don't sell, or arguably AMD, which maintained small share and kept some support by the industry just to make sure there was a second player. And then in the explosive growth side, so the customer love side was always there. But even if you weren't convinced on that, and I think everybody was convinced on that, the explosive growth was over 100%. The revenue growth was over 100%. For a couple of years running. So the stock tracked that and was an exceptionally high performer. So I think, again, it kind of shows how powerful it can be, because you can go into a space like semiconductors, not know a whole lot. You actually just needed to know what I told you just then, that all the developers love it. It's the only solution for very important workflows, and it's growing at over 100%. That was enough, because it looked like there was going to be a broad semiconductor boom, but it didn't happen. AMD has been a terrible performer. The index is still well off its highs, probably nearly 20% of its highs a year ago. So you're talking about negative. If it doesn't rally in the next few months, it'll have significantly negative yearly returns. It hasn't been this broad, wide sector uplift. A lot of money has been spent by a lot of companies trying to attack NVIDIA, and so far unsuccessfully. And so NVIDIA has, the same way Apple did in smartphones, NVIDIA basically captured the whole profit margin of the industry, or the vast bulk of it, sharing some of it with Taiwan Semiconductor and even less of it with ASML. It's a really powerful demonstration, again, of why it works on the largest possible scale. Now, we obviously look at small opportunities, like we talked about, but it is interesting that it's there. Why is it a pivotal moment now? Well, there were those comments from Microsoft CEO Satya Nadella around, not investing or leasing the fact there's oversupply. He's clearly rethinking how much he wants to grow his capex, and that's one of the key. His capex is Nvidia's revenues and profits, a decent chunk of it anyway. Capex does disappoint. Everyone's still building data centers. These plans are made well in advance. There's a host of companies with nothing other than a data center that they're leasing out to Microsoft or whoever else. And if it does turn out that there's more than expected, this is one of those situations where a small imbalance in supply and demand can lead to a huge change in pricing, and that could lead to another big semiconductor cycle. So I think the explosive growth is particularly important. Certainly for the last 2.5 years, just following those two principles would have got you into the best performing, large cap, mega cap stock. So it's encouraging to see that the framework still works and you can still apply it in a very complicated, competitive environment, and then identify the company that's going to make, in this case, trillions of dollars.
Absolutely. And touching back on Satya Nadella, and we spoke about him briefly in the beginning, but what do you think his perspective on overbuilding data centers will influence the future of CapEx and tech infrastructure? Because obviously he has such an influential position. Do you think that his comments will influence how other competitors act in this space as well?
It's a good question. It's a good question because the issue is of these people making these decisions. Let's say maybe there's obviously the big four like Amazon, Meta, Microsoft, Google. Apple's not really competing here. And then obviously you've got the countries, then you've got the Chinese competitors. But there's only a few people buying those like setting that demand, setting that CapEx plans. The problem is none of them want to really be left behind. So I do wonder if there's some signaling going on. So what is most rational in these situations is actually for everybody to coordinate. Often that's illegal. You can't, a group of competitors can't sit down and say, actually, you know what, let's all build less. Let's all keep supply lower than it would be otherwise. He's obviously an extremely intelligent person, risen to the top of a very competitive organization, and then done exceptionally well to turn Microsoft into the company it is. Remember, he took over from Steve Ballmer. Steve Ballmer missed social, search, cloud computing. Basically every major computing platform in a decade, Steve Ballmer missed and underinvested in. Satya Nadella took over and then just really turned that ship around, made Microsoft Azure, their cloud platform, what it is today. And so I do wonder if he is signaling to the other CEOs that he's going to wind back a bit. Because what you don't want is, what would be really risky, the risky moment for them is that nobody winds back, and because nobody can afford to miss out. So let's say 3 out of 4 top spenders pulled back, but one went forward. It could be Elon Musk, it could be Zuckerberg. Nobody can be left behind, and if one company makes a huge investment and it ends up unlocking, the scaling laws continue and they end up dominating for a year or more, and that dominance gets reinforced, they get more data, all the customers use it, it becomes embedded in consumers or in business, and they end up dominating, that would be disaster for all of them. So Microsoft is kind of almost the leader. It's almost like the biggest, and it's the one that's partnered with OpenAI. It's got possibly the most resources. It doesn't have the same threat that Google has with search around AI. It's really workflow upside for them. You'd have to take his comments very, very seriously. If you're an investor in a neocloud, and often it's like the second derivative, right, that usually drives markets. It's the growth is all priced in, then it's the growth of the growth, or the shrinkage of the growth. It's that change. That's that second derivative that often drives things, and he seems to be signaling that certainly that second derivative has changed for Microsoft. And I think that's a really important takeaway. There was a report from Cowen, one of the research houses, that used third-party data to identify leases or plans Microsoft had cancelled, which would be extremely powerful if combined with his comments. Microsoft has said that's not true, so it's jury's out as to whether, just because a few data centers are not being open, maybe they're somewhere else, or maybe it's just a tiny proportion, or you can't draw too much. I actually find third-party data worse than useless, to be honest. It was really useful for a while when nobody was using it, but now there's an entire industry on third-party data, and then the market moves based on the third-party data, and then people recreate the third-party data, and they have been doing for years. So the hedge funds will buy the same data that the third-party data providers have and just front run it by a day. It's the worst. It's like getting a stock tip. It's not complete. It never tells a full story. And the more complete it is, the more likely it's priced in anyway. It's almost like it's like you switch from trying to figure out what the company's going to beat to then figuring out whether the company's going to beat or underperform relative to the third-party data. So you've got the same issue. We spent a bit of money on that stuff and cancelled it a couple of years ago for that exact reason. And it looks like Cowen might be wrong here. But Satya Nadella is signaling to somebody that he intends to lease more than he intends to build, and he's very comfortable with data center pricing going down. It's an interesting comment, and I'm glad we have risk models that will control our exposure to that space. So we're currently quite invested in semis, but we're kind of all year we've been hovering around this pivot point. Like, is semiconductor rally happening? Is it not? It's not this year. If there's like a crash and an oversupply, I can guarantee you the next rally is going to be as big, if not bigger, than the one we just saw over the last 2 years. So you really want to have a coherent strategy that's going to work in both the case of an oversupply and a crash.
Right, and that's absolutely something to look out for in the next, if not this year, 2 years or after that. But
yeah, definitely. I mean, the long-term view is compute's going up, and that's been a story ever since the first computers were kind of like developed, depending when you count. Not quite 100 years ago, but close. Why don't we wrap up there, Elle?
Sounds great. Thank you for having me back.
Thanks so much for coming on.